So now we finally get to the ultimate point of the chapter, and that is to calculate the weighted average cost of capital. And we're ignoring flotation costs, which means we're going to go with that relying on the retained earnings number. If you remember, we took the average and we got 14%. So we take the target capital structure. The weight on debt was 30%, preferred stock was 10%, and for common equity it was 60%. We take our rate on debt that we got, which was 10%, 1 minus the tax rate, so 1 minus 0.4 was 0.6. The rate on preferred that we estimated was 9%, and the average for the cost of common equity components was 14%. And so we get a weighted average cost of capital of 11.1%. Now, this is very important. We had to have a whole chapter on it because in the next chapter, we'll use the weighted average cost of capital to figure out the net present value for different projects, and that helps us know if we should accept or reject a project for a company. And this is a big deal because if we accept projects that make money for the company using the weighted average cost of capital, then we maximize shareholder return, which is our ultimate goal. If we accept bad projects that don't even earn 11.1%, then we are basically ruining the company. And then there's some factors that influence the company's weighted average cost of capital, and some things they can't control, like the current state of the economy, what are the interest rates right now, what are the tax rates based on legislation that's been passed. Things that the firm can control if it needed to somehow try to adjust its weighted average cost of capital would be they can change the percentage that they want for their target capital structure. They could change their dividend policy. They could keep more in, not pay out as much as in dividends. And then also they could change their investment policy. They could stop taking on the riskier projects and take on safer projects, and that would reduce their overall weighted average cost of capital. So the next question is that 11.1% that we got. That's the composite weighted average cost of capital. And the question is, should we use that 11.1% as the hurdle rate for each of its projects? And as you can see, the answer is no, because the 11.1% is representing the risk for an average project for the company. If you have a riskier project, you'll want to adjust that weighted average cost of capital upwards to discount future cash flows. And if you have a project that's less risky, then you could adjust that 11.1% down to account for the fact that it's a less risky project. And so if we look at the next slide, you can see that you've got they've got a new example here with firm A that has a composite weighted average cost of capital of 10%, and they've got two divisions, Division H and Division L, and they've showed here that Division L, the risk is low, and its weighted average cost of capital is 7%. And Project L that it's considering would generate a return of 9%. So if they were using that 10% overall composite weighted average cost of capital and they saw that this Project L returned 9%, they would reject it. But the correct way would be to base it on the 7% Division L weighted average cost of capital. And in that case, they would see that 9 is greater than 7 and they would accept the project. And then we look at the high-risk project, Division H, and its weighted average cost of capital is 13%. But the project generates 11%. And according to this overall composite weighted average cost of capital, we would have accepted Project H because we would have said, well, 11% is greater than 10, so we passed over the hurdle rate. However, if that division's weighted average cost of capital is really 13 and the project only returns 11, then you would be taking away value from the shareholders, and that's something we always want to try to avoid. So really, project H should be rejected and project L should be accepted. And we have finished chapter 10.